If your investing plan requires a forecast, it has already failed. The alternative is a four-part system that protects compounding from debt, fees, forced decisions, and panic. Invest $500 monthly for 30 years. At 7%, you reach about $610,000. Lose 1 percentage point to extra costs, and you reach about $502,000. Same market, same saving. Roughly $108,000 gone. Hypothetical, not a forecast, but the lesson is real. Complexity is expensive. That is the useful core of J.L. Collins' Lutzelm's The Simple Path to Wealth. The book is not valuable because it tells you what the market will do next. It is valuable because it builds a plan that does not need to know. Here is that plan in 4 blueprints. Blueprint 1. Before you build a compounding machine, make sure you do not already own one running in reverse. High-interest consumer debt is negative compounding. An investment balance works to expand your future choices. A credit card balance can quietly consume them. Every interest charge becomes a claim on income you have not earned yet. Suppose you carry $5,000 on a card charging 20% a year. If the balance remains near that level, the first year alone can cost roughly $1,000 in interest before additional fees or new purchases. Meanwhile, the market offers no guaranteed 20% return to rescue you. That creates a simple order of operations. Stop the expensive, predictable leak before trying to optimize an uncertain return. This does not mean every form of debt is identical. A fixed low-rate mortgage is not the same structure as revolving credit card debt. Taxes, liquidity, penalties, and personal risk all matter. The decision rule is narrower. When the cost is high, recurring, and contractually certain, eliminating it may do more for your financial system than adding another investment product. Think of wealth as the distance between your income and the claims already placed on it. A person earning $100,000 with large monthly obligations may have less freedom than someone earning $70,000 with no high-interest debt and room to save. Income tells you how much money enters the system. Obligations tell you how much of that money still belongs to your future. So Blueprint 1 is not pick the perfect fund. It is stop compounding in the wrong direction. Blueprint 2. Once the leak is controlled, the next asset is not necessarily a stock. It is time. Collins uses the blunt phrase, F you money. The useful idea is financial optionality. Enough accessible money to keep one interruption from forcing a bad decision. Consider Maya. She earns $72,000 a year, invests $500 each month, and has 4 months of essential expenses in cash. Then her employer cuts her position during a market decline. Without the cash reserve, Maya may need to sell investments after prices have fallen, stop searching for the right job, or accept expensive debt just to pay normal bills. With the reserve, the market decline is still unpleasant. Job loss is still serious. But neither event gets to make the next decision for her. That is what cash buys. Not maximum return, but control over timing. The correct reserve is not one universal number. Someone with stable employment, strong insurance, and 2 household incomes may need less runway than a freelancer with dependents and unpredictable income. So measure the reserve in months of essential expenses, not in a status number copied from someone else. Ask, how long could this system continue before I was forced to borrow, sell long-term assets, or accept a decision I would otherwise reject? The goal is not to hold every dollar in cash forever. Cash usually sacrifices long-term growth and loses purchasing power to inflation. Its job is more specific: protect the compounding assets from being interrupted by real life. Blueprint 2 is, buy enough decision time that short-term chaos cannot automatically destroy a long-term plan. Blueprint 3, now we reach the investment itself. The engine begins with a gap. Income minus spending. That gap becomes capital. Capital buys ownership. Ownership, left alone over long periods, can participate in the growth of productive businesses. No gap means no fuel for compounding. That is why the savings rate often matters more at the beginning than finding a slightly better fund. The system should make this conversion automatic. Paycheck arrives. A predetermined amount moves into the appropriate investment account. That contribution purchases broad, diversified ownership at low cost. The process repeats without waiting for a prediction, a headline, or the perfect price. An index fund is one tool for doing this. Instead of asking you to identify tomorrow's winning company, a broad index holds many companies according to a defined market rule. Businesses enter, grow, shrink, and leave. The investor does not need to predict every winner in advance. The latest SPIVA scorecard illustrates how difficult that prediction game has been. About 90% of actively managed U.S. large-cap funds underperformed the S&P 500 over the 15 years ending December 2025. That statistic does not prove that every active strategy must fail. It compares a specific fund category with a specific benchmark. But it does show why "I will simply choose the winners" is not a dependable beginner plan. Broad ownership also does not mean one identical fund for everyone. U.S. investors may use a total U.S. market fund, a global fund, or a combination. Investors in other countries face different products, taxes, currencies, account rules, and diversification choices. The principle is broader than a ticker symbol. Own many productive businesses, understand what you own, keep recurring costs low, and automate the behavior. Now return to the opening calculation. $500 a month for 30 years at a hypothetical 7% annualized return grows to about $610,000. Reduce the net return to 6% and the ending value falls to about $502,000. 1 percentage point sounds tiny because it is tiny in 1 year. Compounding makes it large by repeating it hundreds of times. Costs are not automatically bad. Advice, tax planning, and specialized services can create real value. The test is whether you can identify that value and whether it justifies the full recurring cost. Blueprint 3 is not never pay for help. It is automate broad ownership, then make every layer earn its place. Blueprint 4. This is where simple investing becomes difficult, not when you choose the fund. When the fund falls. Stocks do not provide long-term growth in a smooth line. Corrections, bear markets, and severe crashes are part of owning them. A plan that works only while prices rise is not a complete plan. That is why asset allocation is not a personality quiz you answer during a bull market. It is a survival design. In the accumulation phase, an investor is still earning, contributing, and buying assets. Lower prices allow each new contribution to buy more shares. In the preservation phase, the portfolio may need to support spending. A large decline now has a different job and a different risk. Bonds, cash, or other stabilizing assets may help reduce the chance of selling stocks to fund near-term expenses after a crash. Same market, different phase, different system requirement. The right mix is not the allocation with the highest result in a backtest. It is an allocation connected to your time horizon, need for withdrawals, risk capacity, and ability to continue when the account balance becomes frightening. Here is the test. Imagine the stock portion of your portfolio falls 40% and the news says the decline will get worse. What happens next automatically? Do contributions continue? Do you rebalance according to a written rule? Which assets cover near-term spending? Under what condition, if any, would the plan actually change? If the answer is, "I will decide when it happens," then panic is still part of the portfolio. A useful system makes the important decisions while conditions are calm. And it accepts an honest limitation. Simplicity does not remove risk. Broad diversification cannot prevent losses. Low fees cannot guarantee returns. Staying invested is only sensible when the allocation, liquidity, and time horizon were appropriate in the first place. Blueprint 4 is: do not build the portfolio you wish you could hold. Build the one you can realistically survive. The simple path is not a magic fund, it is a sequence. Stop expensive negative compounding. Buy enough decision time to protect long-term assets. Automatically convert the gap between income and spending into broad low-cost ownership. Then design the allocation and rules before the crash arrives. You can now test every component in your financial system with 3 questions. What job does it perform? What does it cost each year? What will I do with it during a major market decline? If you cannot answer all 3 in one sentence, that component may need more investigation, or it may not belong in the system at all. Books are not personal financial plans, and this video is educational rather than individualized advice. Your taxes, accounts, country, debts, time horizon, and risk capacity can change the right implementation. But the central idea survives those differences. You do not need a financial life that demands permanent attention. You need a system simple enough to understand, inexpensive enough to keep, and resilient enough to follow when the future becomes uncertain. That is why boring wins.
If you found this analysis valuable, leave a like and comment. It helps the video reach more people who care about long-term financial thinking.
And subscribe to the Finance Blueprint for more structured breakdowns of the world's most important financial ideas.